We will bring you the headlines. In the meantime, Fox Business Alert, that news that American chip companies can now start exporting their semiconductors to China is no doubt part of the propellant pushing the NASDAQ to a record. We've got the NASDAQ up 85 points, or just under 0.5% to 20,725. Any gain, though, even just a fraction of a point, puts another record for the NASDAQ in the history books. The question for the broader indices is, can second quarter earnings season give the markets maybe more definitive direction? Because for the moment, while the NASDAQ is up, the direction for the S&P and the Dow is down. We've got the Dow down 377 points, S&P down 14 points. And that's despite four major financial names, J.P. Morgan Chase, Citigroup, Wells Fargo, and BNY Mellon beating estimates. However, maybe the next batch of banks to report right tomorrow morning might do the trick. Tomorrow morning, it's Bank of America, Morgan Stanley, Goldman Sachs, PNC, and M&T Bank. They all will reveal their quarterly numbers. Should you buy any of these ahead of their reveals? Let's get right to the floor show. Gerard Cassidy heads up U.S. Bank Equity Strategy and Large Cap Bank Analysis at RBC Capital. Gerard, you've got a positive on four of the names that reported today, and they're the four that beat estimates, and yet three of them are in the red. Tell me about J.P. Morgan, because at what, $5.17 billion, net income on the consumer and community bank side crushed it both month over month and year over year.
Yes, Liz, the numbers from J.P. Morgan were very strong. The stocks, though, coming into the quarter, you might recall they all bottomed out around the first week of April and have had very significant moves. So some of this weakness today, I believe, is just positioning by different types of investors, maybe taking some profits and so on. But the outlooks remain very positive for all the banks, even though the stocks are a little weaker today.
Yeah, you had Jamie Dimon coming out and saying he's still worried, but that's just Jamie. He's always fretting, unlike some of the other bank CEOs who have not worried about a recession, which actually never came to pass. But if you bring it to Wells Fargo, it's taking an outsized hit. Can you talk a little bit about why you think that is?
I think part of it is that the stock may have gotten ahead of itself in view of the asset cap being lifted. The asset cap was part of the regulatory cease and desist order they signed in 2018. And the company has been working very hard to have it lifted. And it was lifted about 5 to 6 weeks ago. And I think some folks thought that they would see rapid growth in the balance sheet over that period, which obviously did not happen. And management was very conservative in their outlook on how they're going to grow that balance sheet. In addition, the company gave us guidance on the net interest income, which of course is the revenue they generate from assets less funding costs. And that outlook was lowered a little bit from the first quarter. It's going to be flat this year, they think. And that was down from some growth of 1 to 3% earlier. So the combination of those factors, I believe, have contributed to the stock selling off today.
Well, you didn't see J.P. Morgan lower their full-year guidance for net interest income. So I think that's really what spooked maybe perhaps some investors. Well, I find Citibank quite a surprise here. Jane Fraser busting a move here. And I really liked some of the points here. Citi Services, she called it the crown jewel, gaining 28% year to date for the stock. Net income jumped $4 billion to $4 billion versus $3.2 billion last year. That's a nice move, and it looks like they are finally finding their pace.
You're absolutely right. You have to tip your hat to Jane Fraser and her management team. They're delivering on the repositioning of this company. They're simplifying it. She's exited a number of businesses with the expectation of exiting Mexico, their Banamex consumer banking business, by the end of the year, early into next year. But what's really interesting here, Liz, is the fact that with the outlook for deregulation in the banking industry and the freeing up of excess capital, all the banks will benefit, including Citi. But Citi's stock price relative to book value is the cheapest among the group. Okay. And therefore, their buyback, which was stronger this quarter than expected and is expected to be stronger next quarter, has really added the fuel to the stock this year.
Gerard, we do have to run, but why do you feel that there's no risk of funding costs going up when, I mean, right now, and this is a longer term treasury, but the 30-year Treasury bond is above 5% for the first time since June. We're not seeing interest rates coming down. We got CPI this morning, the Consumer Price Index, which pretty much matched estimates. But if you dig into it, you saw that there was a little bit hotter than expected inflation in things like toys and apparel. So you're not worried about that? There's no risk to banking?
We're not that worried about it because the industry is not levered up. When we look at a measure called the loan to deposit ratio, it is still very, very low. So the banks are not stretched for deposits at all.
Okay.
And in fact, because of the low loan to deposit ratio, they have some optionality on pricing of deposits.
Okay. And I noticed that all three, at least of the big ones, Wells Fargo, JP Morgan, and Citi, lower than expected provisions for credit losses. That always makes me a little nervous because that's the dry powder you save for a rainy day. That doesn't worry you?
No, actually, Liz, credit quality is very strong. A lot of people have been very worried about the consumer. And in fact, the consumer is doing quite well. And the provisions for loan losses, to your point, came in lower than expected in some cases. But the reserve levels are quite healthy. Credit losses are very manageable. And the underwriting still remains very strong.
Good to see you, Gerard. Thanks for pulling it apart for us. We appreciate it.